All right,
Right.
guys, that's it for Stock Talk here. We're going to move into our last segment of the day here for the halftime report, and that's going to be called Jedi Options. And I've really enjoyed this over the last 3 or 4 months as we've been doing these different segments, Tyler, day by day by day. Jedi Options really highlights your skill sets, and it's something I know you're an excellent educator in the options market. You've taught our students for years and years and years how to trade options effectively, portfolio design, different concepts, hedges, you name it. And so what we do every Wednesday, guys, if you're new to the channel, is Tyler gets a chance to just teach something he wants, whether it's a strategy, a concept, an execution of a bid-ask spread, what an order entry, whatever's on his mind from an options perspective, he dives into it to give you guys a little bit of education. Tyler, what do you got today for Jedi Options?
Got a lot today for Jedi Options. Going to mix in a little bit of economic theory, a little bit of intermarket analysis. We're going to take a look at interest rates and bonds. And we're going to do a bearish trade. If you believe interest rates continue to go up, there is a way to make money on that. The beautiful thing about the financial markets is if you have an opinion on anything, you can probably make a trade and make a bet on that, right? And isn't that like a theme for the world right now with DraftKings and Penn? We're getting to the point where you can almost bet on anything. Here's the situation today where we're going to be betting on interest rates. But to set the stage, I got to explain a little bit about how this works, like the fundamental analysis side, because you do kind of need to know that a little bit just to be more intelligent. Honestly, as I say that, I'm like, no, they don't. You can just show them the bullish chart and the bearish chart and just build a bear trade. But I want to expand your horizons, right? If you want to become a Jedi, you want to know how the world works a little bit. So here's the deal. What has been spooking the markets? One thing among many things, but I think the primary culprit has been this quick rise in interest rates. And the interest rate that you will see Wall Street track the most is the 10-year Treasury yield, which is the interest rate on 10-year Treasury bonds. You can chart it a couple different ways. I always use TNX. And this is basically 10 times the price of what yields are at. So if yields are at 1.5, this will be at 15. If yields are at 1.4, this will be at 14. So you just move the decimal one to the left, and that's essentially what the interest rate is. So a couple things you'll notice. Number one, after the election in November and the vaccine that we got with Pfizer, interest rates went bananas because they were pricing in economic growth. And generally, interest rates rise with a growing economy because inflation ticks higher, the cost of capital ticks higher. If the rise in interest rates is driven by expectation of stronger economy, it's kind of a good thing. But it does raise the cost of capital, which has some negative impact on companies who are high growth companies or high multiple companies that expect to make a lot of money in the future and are not making money now. And normally, if interest rates are zero, this gets to what we call the discount rate. In theory, a stock is worth all of its future earnings discounted back to today. And so if interest rates are zero, whether you make $1 million today or $1 million in 10 years, the value is the same because there is no time value of money because interest rates are zero. If interest rates are 2%, you'd rather make the $1 million today because then it can grow at 2% each year moving forward. So when you get higher interest rates, it lowers the value of future earnings. So if you look at these high growth tech companies, the reason they're so sensitive to rising interest rates is because a lot of these companies, how about any of them? Any of these high growth tech companies that are expected to grow a lot in the future, but maybe aren't profitable right now, their future earnings become less valuable as rates go up. They're the most vulnerable in a situation like this. That's why in February and March, the tech sector got hit the hardest. That's why right now the tech sector is getting hit the hardest. Now, why does this matter to me today for this Jedi option segment? Well, partially it matters because if this breakout in interest rates goes the distance, that is, if we see an echo of what we saw in February and March, this may not be just a ruse and we come right back down. This could be the beginning of a sustained uptrend in interest rates. maybe we get back up to where we were in March and April, which is 1.7% on the 10-year. If that's the case, probably continues to put a damper on tech stocks. It's probably beneficial for banks and energy and cyclicals. But more to the point today, this is also going to be bearish for bond prices. So interest rates or bond yields and bond prices move in opposite directions. So what you've seen over the last week as yields have gone up is bond prices have tumbled. This has been one of the things that's been difficult and insulting about market movement this week. People who own bonds own them in part because they're a safe haven, the stability. They don't tend to move as much as stocks. They expect them to go up when the stock market goes down. If you had a diversified stock bond portfolio yesterday, you first looked at your stocks and you're like, oh my gosh, I'm getting killed. Oh, that's okay. In days like today, bonds provide a little bit of safety. And then you look at your bond segment, you're like, hey, what's going on? I'm getting killed in bonds, here. So yeah, it was a double whammy over the last couple of days where stocks get whacked and bonds get whacked, and Bitcoin and gold and all the rest. There was nowhere to hide. Well, if you think that's going to continue, if you think the breakout in bond yields is the real deal, and you think that bond prices will continue to fall, there is a bond ETF, TLT is the long-term bond ETF. There's multiple ETFs that track bonds, but the long-term bonds are the ones that are the most sensitive to interest rates, that actually moves enough to warrant trading. Quite frankly, I've yet to find another ETF that moves enough in bonds to bother with trading. TLT is like your only option. But TLT has broken support, just as interest rates have broken resistance. And this could be the beginning of a downtrend. So if you do some old-fashioned technical analysis, got a little bit of a double or triple top here, you're breaking support, you're breaking the moving average. Not a good look. TLT was down at 133 when interest rates peaked back in March. So it's not like this thing couldn't go lower if interest rates go higher. So I'm bearish. I want to build a bearish trade. This also, I think, is ironically, in a roundabout way, kind of a hedge, because if interest rates keep going up and that causes stock prices to go down, bond prices will probably go down as well. And so this will maybe offset some of my other bullish trades that I'm suffering on in stocks. So what kind of trade do I want to build here? What kind of strategy? Well, I'm never really that aggressive enough to do a long call or a long put. So a bear put is about as aggressive as I get on the bear side. What I'm thinking is I'm going to buy a put option in TLT, maybe like the 145 or 146 put, and then I want to sell a lower strike put against it. I'm going to go to November. I think we got a pretty good like potential support zone around 140. So that's my target. I want to buy the 145 put in November, and I want to sell the 140 put against it. It's $1 in the money. I bet this thing will cost me $1.50 to $2. It's a $5 spread, so I'll be able to make $3 to $3.50. That's a good little risk reward, I think, for a pretty sound trade. The fundamentals back me up. The chart backs me up. I think it's a decent idea. So to build out the play, going to go to November, going to buy the 145 put. Again, if I was really aggressive, I could just buy the put for 380 outright. But to reduce the cost and enhance the leverage, I'm going to sell the 140 against it. 212, and I was hoping to be $1.50, but can't always get what you want. $2 still good enough. Risking 2 to make 3. It's 150% potential return on a bond product. If it just goes down a little bit more, which it will if this rate rise is the real deal and we get some follow through. So $2.12, November 145, 140 bear put vertical spread. That's your way to play rising rates.